This is Rob Sedaghatpour from Stratco Property Solutions, here with my partner Mitch Flaherty from B6 Real Estate Advisors. We have the well-noted and well-famed Professor Munsell, from the head of the real estate program at the Questrom School of Business at Boston University, and one of my former professors, share with us his thoughts on inflation and the state of the multifamily market. Professor Munsell is a longtime professor at Boston University, former developer and loan officer. Mitch, if you can lead us with the questions relevant for today.
Yes, thanks, Rob, and thank you again, Keith, for joining us today. We appreciate your time. So the first question is pretty generic, but just to kick off, what can we learn from previous interest rate increases and how that affects the market today?
Well, let me give just 30 seconds of background, if I could. When the Fed increases funds rate to slow a booming economy, as it has, it affects the business and consumer activities and their access to credit, making it obviously more expensive to borrow, and in theory, create a drag on the economy and thus slow down economic growth. And as we know, mortgage rates are tied to 10-year treasuries and therefore rise in sympathy with the Fed funds rates, making it more expensive to borrow and dampening demand for housing and commercial real estate. Now, directly to your question, when we look back to the 70s, the late 70s and the early 80s, we can see this effect historically. When the Fed funds rate rose to over 18% in the late 70s, by the early 80s, there was a 50% drop in home buying and a similar decline in new construction, both residential and commercial. And I'm afraid history has a tendency to repeat itself.
Okay, so looking back and learning from past experiences, is inflation generally a good thing for real estate going forward? Some would argue yes, as your leases are on a yearly basis, particularly in the residential sector.
Well, the quick answer to is inflation a good thing for real estate is yes, but, and I would put a big caveat here. Historically, real estate has been a very good hedge against inflation. Over 10-year periods, home prices have beat inflation by a couple of percentage points, except during recessions. Commercial rents rise, but so do expenses. But the debt cost, if the debt cost is fixed, hopefully the spread between increased rents and increases expenses will flow to the bottom line. Material costs, as we know, and the cost of transportation to get construction products to the market are rapidly rising, making construction even more expensive, and should result in existing housing and commercial stock appear to be a bargain by comparison to new construction. To make the counter argument, however, and there are always two sides to the coin, to make the counter argument, however, if interest rates rise, then cap rates should rise as well. And as we mentioned, historically, 10-year treasuries, 10-year treasuries and cap rates are positively correlated. Thus, a rise in treasury should mean a rise in capitalization rates, which should mean a decline in values, making real estate less attractive if you cannot pass along the rent increases as rapidly as expenses increase.
Talking of recessions, a lot of people feel like the Fed left it too late in terms of increasing interest rates. Do you think rates are going to keep going up at this pace? And do you think we're heading towards a recession?
The answer to that is yes and no. I think that the rates are going to increase, but not at the same rapidity in which they are. And I do think that recession is possible. And, one never knows what's going on in the world economy. We are not alone. This appears to be a problem throughout the industrialized countries, maybe with the exception of Japan, which has kept their interest rates in the negative levels.
So where do you think interest rates should be today? I was looking at the 30-year fixed mortgage rate this morning at 6%. Inflation's 8.5%. To curb the inflation, does there need to be another 200 basis points increase?
Well, you're asking me to look in the crystal ball, which in the last 50 years of working in this business has, I'm afraid, continued to be fuzzy. But I would say, we have been accustomed to artificially low interest rates.
Mhm.
And I think that when we looked at capitalization rates and when we looked at debt service coverage ratios, we thought as an industry that they may be artificially low. And so we introduced something called debt yield, because debt yield has nothing to do with your desired return on equity, nor does it have anything to do with your cost of capital. And so I think that was instituted a number of years ago in anticipation of rising interest rates. So to your question, where should interest rates fall off? I think we're probably looking at the high sixes, maybe low sevens. Historically, still pretty good. But
Yeah.
of course, when you've been accustomed to 3%, more than double 3% looks pretty bad. But I can tell you that years ago, I bought a small apartment building at 3 under prime. 18% was the interest rate I was charged.
Wow.
So
So are there any other, within the commercial real estate sector, do you think there's any asset types that are better hedged against inflation or perform better in inflationary environments?
well, you've asked the question as to where to put your money.
Yeah.
Listen,
Where should we put money, Keith?
well, here in Boston, if you put your money in life science, seems to be pretty good, because we don't seem to be able to build enough of that. And we seem to be able to charge almost 3 times what we can charge for office rents. And so, as we know, a number of developers, a number of owners are converting their office space into life science. Not as easy as it sounds because of all the demands for life science. But I think the demand is there in large part because you can't do the lab work at home. Office space, I think, is going to continue to have downward pressure, with the idea that people have enjoyed working from home. They've enjoyed the money savings and time savings from not having to commute. And so I think that, like retail, will continue to experience downward pressure. I think residential. Now, I understand, and I don't understand it completely, but I understand New York has stabilized rents. And so I'm not sure how quickly you can pass on your increases in operating expenses. But if you can pass those on, and once again, if you have a fixed cost of interest and debt, or fixed debt cost, I should say, I think you should do well. People want to live in the city. They want to be around a vibrant community. I think core-based assets are going to continue to do decently. I think in tertiary communities, they're going to still be under a lot of pressure. So if it were me, I might put my money in warehouse, because everybody wants last mile, and I might put my money in life science. I think residential real estate's a push, good and bad. I would be looking to get out of office and retail and lodging. Well, good luck.
Great, thank you.
So I'm going to share, we're going to wrap up today. Professor Munsell, thank you very much for, let me just bring the correct slide up. Here we go. For joining us today. Good to see you after many years. Thanks again for joining us on the Stratco B6 current webinar on multifamily and inflation. Have a great day, everyone.
Thank you.
Thank you. May I make one final comment, which you can either edit in or not edit in?
Go ahead, Professor.
Well, maybe 2 final comments. If you remember from the old days, you can't shut me up. So I'm saying, there is a negative effect to rising inflation and interest costs. that also may exacerbate the wealth gap. Because what it's doing is it's taking marginalized renters and marginal buyers out of the market because of rising costs. In addition to that, commercial tenants have restricted growth that will percolate down to employees and to their level. And so thus demand for all real estate may in fact be absolutely tied to what the Fed is trying to doing. My last observation is consumer confidence is down. The home builders sentiment index is at its lowest level since pre-COVID times. And hopefully we will not mirror what's happening in Canada, where home sales and home prices are down. I don't believe that's going to happen in this country, though I do believe that there will be a continued rise, but a slower rise in value. Thank you guys for your time.